What if the recession that everyone's fearing already happened secretly and under the radar? These 13 charts reveal an undeniable stealth recession, and the proof is in the data. So, before we get into the data, very quickly, the NBER, or National Bureau of Economic Research, is the final arbiter of a recession, specifically their business cycle dating committee. They note a recession is the period of economic activity that is between a peak and a trough, and that the definition of recession means a broad based decline in economic activity. And so therefore they look at a variety of different sort of economic metrics. We're going to do the exact same thing and start with the labor market. So what I want you to focus on the rest of the video is the red line, and specifically the dynamic coming out of recessions, which, by the way, are shaded in red. These red vertical lines are official NBER declared recessions. And what we're looking at down here is the rate of change of a moving average of the data point, in this case, job openings. Now, the rate of change is helpful because, as we can see, for example, this has a very tight correlation, job openings, to real GDP, to the annual growth rate of the US economy. So is a useful way to think about it. Now, coming out of .com, again, official NBER declared recession, we can see a deceleration. The rate of change was negative, but then it starts to decelerate and kind of bottom out. And then it starts to actually turn positive. And that is exactly what we see coming out of .com, 2008, 2020, and this stealth recession. So keeping in the labor market data, here's separations, same exact dynamic coming out of .com, coming out of 2008. This shows a bit of a double dip sort of recession with separations that we can see there. But again, a very clear dynamic that is only characterized by prior recessions. Now, here we're looking at hiring, again from JOLTS. And the same dynamic is true, a deceleration in the negative rate of change, and then it starts to pick up, like coming out of .com, 2008, 2020, and of course, now. So unemployment, now we can look further back because JOLTS only goes back to 2000. Unemployment goes further back. And again, every single other time that you have seen, this is inverted, by the way, to keep the visual consistent. But every other time you have seen that kind of acceleration of unemployment and then deceleration, which is what we're starting to see here. Remember, it's inverse. That every other time that has happened has corresponded to an official NBER declared recession going all the way back to the 1960s. Now, again, with the broad-based metrics, we're going to look at credit and consumer credit, specifically the charge-off rate on revolving credit or credit cards. And again, we're taking a moving average of the underlying data point to smooth out volatility. Then we're looking at the rate of change. And again, this is inverted to keep the visual consistent, but we can see going all the way back to 1990, very consistent, characteristic post-recession recovery, where this is starting to actually, of course, we saw an acceleration. Remember, it's inverted, an acceleration in defaults, but it is starting to decelerate and actually go the other way. Now, M2 money supply, remember, this is a broad measure of the money supply, including private bank credit creation, which is the majority of credit in the system, about 90%. Official kind of bank reserves and currency, which is created by the government, that's counted in M0. Here we're looking at M2, and again, the rate of change of the underlying moving average. This is actually the only time that it went negative. The M2 rate of change went negative, going all the way back to the Great Depression. But I did want to throw it in there. Here is total loans and leases. Again, we can see a very characteristic sort of post-recession sort of dynamic where the rate of change of total bank loans and leases is going negative. It starts to decelerate. The rate of change is decelerating, and then it starts to pick up and go positive, as we can see again here over the past couple years, that very characteristic sort of recessionary visual. Now here, moving on to kind of broader economic activity, here's ISM new orders. And again, ISM covers manufacturing and services. So what we did is take an average between the two of them. And then again, look at the rate of change of the underlying moving average. And again, coming out of every recession, we see the same exact dynamic that we have been seeing going back to 2021 or 2022, depending on the metric that we're looking at. But the dynamic is clear and consistent across all these data points. Here is the overall headline ISM average This is for services and for manufacturing. We're taking an average, then finding a moving average of that average, and then taking a rate of change. And again, very characteristic sort of post recessionary sort of dynamic coming out of the last couple years. Now, here's consumer sentiment. This goes a little bit further back to the 1960s. And again, the same dynamic is true. We see an acceleration or deceleration, excuse me, in consumer credit, and that corresponded to this period of time where consumer credit was falling off a cliff. And then you see a recovery in the underlying moving average. So again, this is characteristic of every other recession, NBER defined or declared official recession. We can see the same exact dynamic with consumer sentiment. Now, here's another one. This is a spread between two bond yields. In this case, the 30-year US Treasury yield and the 2-year US Treasury yield. And this is what's known as an inverted yield curve, by the way, where it dips negative below zero. Generally, you should expect to get more interest on a longer duration bond. But when the curve is inverted, where the yield on the longer maturity is actually lower than the shorter maturity, that is when this dips negative and generally seen as a recession sort of indicator. Well, as we can see, the yield curve has been steepening going all the way back to June of 2023. But again, same visual that we have been seeing across all the other data, indicating that we very well might have had one of these stealth recessions. Here's construction spending, rate of change, and it's inverted again to keep the visual consistent. And what you can see is that this moving average only goes negative in or right before other recessions. And this data goes all the way back to the 1970s. And we can see that it only goes negative. It only starts to accelerate here. And then what we're noting, because it's inverted, is a deceleration in construction spending, which is why the red line is going up. That red line going up is indicating a deceleration in the rate of change of construction spending. And again, we can see a very similar sort of post-recessionary dynamic. Now, finally, to finish up here, here's the S&P 500. I always point out in 2022, we did have a bear market in the stock market, whether you measure the S&P 500 or the NASDAQ. Here we're looking at a 12-month moving average of the underlying S&P 500 for the broader stock market. Then again, we're taking a 12-month rate of change of the underlying moving average. And as we can see, a very clear dynamic that you see associated with other recessions, notably .com in 2008. And we are well into the recovery phase, at least if you look at the S&P 500. Now, some of the labor market data indicates we might be early cycle. It's really kind of tough to say. It is a very tough economy to try to forecast right now, given all the conflicting data and all the changes going on. A lot of the labor market data, like through JOLTS reports, indicates that we are early cycle. But there are some data points, as we saw with, say, the S&P 500, that indicate maybe more mid to late cycle. So it's really tough to say exactly. But I did think it was interesting going through all these different, this wide array of different sort of data, whether it be consumer credit, whether it be private bank credit creation, whether it be the labor market through the unemployment rate, whether it be construction spending or ISM. These cover a wide array of different economic metrics or underlying metrics to measure, and you see the same exact dynamic in all of them. So I just thought it was interesting. Certainly a lot of average Americans feel like we've been in a recession, and I thought it might be interesting to post some of this data for y'all. So anyways, hopefully that was helpful, and I'll catch you in the next one.